But let's keep the spotlight then on corporates. And Home First has seen a 30% AUM growth in FY24. Have the margins for housing finance companies topped out? What's the outlook on asset quality? Manoj Viswanathan is the MD and CEO here to discuss that and lots more. Good to have you on board. Let's just start off with the numbers because you're confident of a 30% AUM growth in FY24. But do you think that you can sustain on a higher base going forward?
We have looked at the outlook for the next 3 years and we feel confident of maintaining this 30% AUM growth. This is based on ground level feedback in terms of the demand and overall development that is going on in various parts of the country, because affordable housing is a segment that is dependent on employment generation and incomes are going up. So we are finding we are finding the feedback positive from across the country.
Just a question, in terms of these housing loans, we have been seeing that it's a luxury market which has been doing a lot better than the affordable housing. Is that a trend you are witnessing as well, or maybe some increase in your ticket sizes that you have seen when it comes to the housing segment?
Affordable housing segment has been, very stable segment all through. If you look at the last 10-year trends, whereas the premium housing goes through ups and downs depending upon interest rates and various other macro events. So because affordable housing is a segment that is dependent on customers who are actually end users who are looking to buy or build properties, for their own residential status. So as such, the demand, generally we have seen the demand to be very stable across cycles.
Okay, fair enough. And a couple of factors, because there's been comparatively lower demand for affordable housing versus luxury, sequentially higher bank balance transfers. Keeping these factors in mind, do you think that there could be a little bit of challenge to your growth going down the line?
As I mentioned, we are feeling fairly confident about our growth targets. We have been talking about, 3 years ago when we listed the company, we were talking about a 30% growth year on year. We have maintained that. Even today, we have kind of done the, outlook planning for the next 3 years, and we feel confident about maintaining a 30% AUM growth.
Okay, I just wanted to understand the competitive intensity in the industry as well, because of course we've been seeing a lot of these players also come into the housing finance space, specifically the affordable housing. A lot of peers have also indicated that they will cut the home loan rates as well in terms of getting more market share. Is this a strategy you would employ as well, repricing loans at a lower rate perhaps?
Not really. Affordable housing is not, if you see the segment, it is not that elastic when you look at the interest rates. The segment operates at a slightly elevated interest rate level compared to premium housing. And, within that segment, it is the demand is not elastic. As in, if we reduce the rates marginally, it is not going to increase our business, multifold. So as such, we don't see rate war or a rate pricing war as being an important factor in the affordable housing segment.
Then what will be your NIMs in that case, your yields and spread going forward?
Spreads, we have always guided to a 5.25% or thereabouts spread. And we have sustained slightly higher spreads in the preceding few quarters. That is because of, a sharp reduction in interest rates post COVID. But we have always been guiding, over the last 2 years that the steady state spreads in this business are more like 5.25%. And we are confident of maintaining those kind of spreads. The NIMs are currently around 6%. And if the interest rates don't go up from here, then we are confident of maintaining those NIMs.
Okay, that's a view on NIMs and maintaining your spreads. You also have a strong capital adequacy ratio, around 45%. What is the headroom you have in terms of your ROE expansion, and how are you expecting this ratio to evolve?
Capital adequacy is, of course, very strong. And this is because we have raised multiple rounds of capital in the last 3-4 years to, protect against, various macro events that have taken place. As we keep building the AUM, this capital adequacy should keep, we should be able to keep absorbing this capital. Of course, the regulatory threshold is only 15%. So we have a long way to go as far as the capital is concerned. As far as ROE is concerned, when we listed the company, we said we'll deliver 15% ROE in FY25. We have delivered that 1 year in advance. So if you see the last 2 quarters, we have delivered a 15+% ROE. And here on, we are confident of increasing that by about 75 basis points every year.
Sure. In terms of your asset quality as well, Manoj, a slight deterioration, if you will, as far as the asset quality is concerned, but still, when you compare it to your peers, it's still looking okay. Is there something that we need to get worried about in terms of the cyclicality of the business and the asset quality worsening?
Asset quality has been fairly stable. As you can see, there has been a minor 10 basis points movement last quarter. First quarter of the year generally is a little worse than the second quarter. So we are confident of improving that going forward.
All right, fair enough. And going down the line as well, you have several notable PEs investors. What are the kind of conversations that you're having with them? Have there perhaps been any internal targets that you have discussed?
PEs have been with us, since we are a 13-year-old company, and for a good part of the journey, we have been a privately held company, mostly held by PEs. And we have given some very good exits to some of the PEs who invested in us. And currently, we have 3 large PEs invested in us, and they are very, bullish about the prospects for the company, and we have a good relationship with them.
What would you say is the USP of your business versus the rest? Because if you look at the growth rates, the asset quality, they do stand a bit different and better than the peers. What are you doing differently then?
As far as asset quality is concerned, it's a multi-layered process. Of course, the underwriting process and the initial onboarding process needs to be very strong. So we have over the years perfected that. And in this segment, even if the underwriting is good, because the customers come from a slightly vulnerable segment, they tend to go through ups and downs. So we have a very strong process of handling the customers through that process, providing exits for the customers. So many customers require help from us, to dispose of the property. So we provide that. We have a strong marketing team that is able to provide that support to the customers. And so it's like I mentioned, it's a multi-layered process. Both from an underwriting, credit, as well as a risk management perspective, as well as from a collection perspective, which helps us to maintain this asset quality.
Okay, good to have you on board. Thanks so much for joining in and sharing with us your growth targets as well as what the outlook is when it comes to financials.